Affirm IPO stock analysis. Welcome, everybody. This is StockerFinance. I am your host, David Scheuer. Make sure to follow me on Twitter, twitter.com/StockerFinance, or patreon.com/StockerFinance to support the show. Today, we're mainly going to be analyzing the Form S1 registration statement for Affirm Holdings Incorporated through the Securities and Exchange Commission here in the United States. But before we get into that, I'm going to read an article. It's a brief quote from this article on Kiplinger Magazine's website that talks about Affirm. I think it gives a great brief history and summary of this company. Now, Max Levin, or Levichin, his last name is spelled Levchin. I'm sorry for pronouncing his last name wrong. He has already transformed the financial services industry when he helped co-found the company that eventually turned into PayPal in the 1990s. He made another attempt at disrupting the space in 2013. This time, he's taking on the traditional credit card industry when he founded the company we're talking about today, Affirm. His goal was to create an offering that's highly transparent and has no late fees or penalties, which is very unique compared to most credit card companies. The Affirm card was also built to allow customers to build or develop their own payment schedules as well as split payments. The company's attracted more than 5.6 million users. Its merchant base includes the likes of Walmart, Wayfair, and even Peloton. Affirm has raised $800 million to date, including a 2019 round of funding that saw top-tier venture capitals and celebrities such as Ashton Kutcher alike generate $300 million. One major competitive advantage Affirm boasts is the AI technology that helps manage the lending risks. The analysis only takes a few seconds to complete and is based on data of more than 7.5 million loans and over 6 years of repayments. Growth has also been really incredible. In fiscal 2020, revenues soared 93% year over year to $509.5 million, while net losses shrunk. Now let's go ahead and get into some more information within the S1 form. The first one we're going to start with here is some of the merchants that they're working with. This includes Expedia, Gucci, this includes Delta. I'm trying to look at some Dyson, also use Callaway. So there's a bunch of different companies, very large companies that are using Affirm as their merchant for partnering with them. Now, continued innovation as well. Here's a little nice graphic if you're watching here. Some people might just listening if you are listening on the podcast, which I'm going to be releasing soon, version of this show. Now, continued innovation. So they have integrated checkout. They pay over time 0% APR interest-bearing financing at our partner merchants. They have their virtual card as well, which is a universally accepted method of payment on Visa rails. They have a split pay, which is a fixed payment plan for purchases under $250. Marketplace, personalized data-driven product discovery. Savings, FDIC insured interest-bearing savings account, which is great as well. They say that their solution for customers is that they are simple, transparent, which is one of their biggest marketing strategies. They're a very transparent company and fair. They say when using their solutions, customers never pay more than the stated amount, which is clearly and plainly laid out upfront at checkout. There are no further charges, penalties for early prepayment, or additional fees even for missed payments. They have a seamless checkout experience. Their logo is displayed all over it, as you might expect. They say first, you find the product, then you go ahead and check out. You use Affirm as an alternate payment option. You go ahead and pay how to choose how to pay. How your transaction is going to go about. You can never pay more than the agreed upon upfront costs, and then you can manage payments in the app, which is simple and transparent. Personally, I've never used Affirm or their apps. I don't have a lot of experience with it. If you are someone who does, please send me a tweet, a DM on Twitter, or go ahead and comment below on YouTube so that I can and give me your review of the company and the app and what you think of it. Now, here's a little graph here. It says their proprietary risk model generates better outcomes, and it's comparing its outcomes compared. This is the graph, by the way, just to summarize what it is, the cumulative first-month delinquencies for February 2020 consumers. And it compares to the FICO, so consumers ranked by FICO and consumers ranked by Affirm. And for a given level of risk, they say that their model is capable of accepting significantly more applications when compared to FICO scoring methods. Now, here's the portfolio net charge-offs. They have their net charge-off rate on the left-hand side, and months since origination on the bottom. They say each line in the chart represents the credit performance of a vintage of loans originated in a given calendar month. For each monthly origination vintage, portfolio net charge-offs represent cumulative charged-off loan principal due to either credit performance or fraud less than any amounts recovered as of a given month after origination. For each vintage and month since origination, net charge-offs are represented as a percentage of loan volume originated. So you can definitely see that clearly stated here. And here's a brief history of Affirm. Here's over the past fiscal year since 2012 when they were founded. They launched the checkout in 2013. They signed with Casper in 2014. Did their first transaction in 2015 with Cross River Bank, and they signed with Peloton as well in 2015. In 2016, they signed Expedia, and they launched their virtual card. They signed with Dyson in 2017, Walmart in 2018. They launched their split pay, which is a very unique transaction method, in 2019. By then, they're doing $2.6 billion. They reached over 2.5 million consumers by then. They launched their savings account in 2020 this year, and they launched their marketplace as well with product discovery. They're at $4.6 billion. And in 2020, they achieved two major milestones in the first quarter of the fiscal year 2021. They signed a partnership with Spotify and completed their first securitizations. Now let's move on here to another chart, and they say that they have a really great merchant retention. So in 2017, they had 236 million. You can show how that money stayed with them throughout. That they're actually basically almost building on to what they already have because people aren't leaving them. You know, they're not having to get brand new merchants every single year. They're staying with them, so it's building and building on top of each other. And you can look at the 2016 cohort, 2017, 2018, 2019, how it's just stacked up on top of each other over time. And that's going to continue to do so, which is a great thing. They have 100% plus dollar-based merchant retention. So the fact that their merchants are staying with them shows that their platform is effective, that they like to use it, etc. We still have the question, though, of can this company actually generate and be sustainably profitable? It's a really common thing these days for a lot of IPOs right now, especially these tech companies, is none of them are profitable. There's only, I think, one company that I'm going to be doing a video on soon that has been sustainably profitable. Maybe two, and the other one is a brick and mortar company, and one of them is a tech company, but it's a very unique company and it's not as well known. So it's pretty interesting. We're going to see whether these people are trending to profitability. It does kind of seem like they are, but we'll get to the numbers in a second here. Here is just their performance. They have increased GMV processed, and they have their DQ performance as well during COVID. They show how this whole situation has improved credit quality, as well as overall it's really boosted the performance of this company. Now here's some revenue sources, because a lot of you may be saying, okay, they're not charging any interest rate. How are they making any money without these fees, etc.? Well, from merchants, they earn a fee when they help convert a sale and power a payment. So merchant fees depend on the individual arrangement between them and each merchant, and that varies based on the terms of the product offering. We generally earn larger merchant fees on 0% APR financing products for the fiscal year ended June 30th, 2020, and for 3 months ended September 30th, 2020. 0% APR financing represented 43% and 46% respectively of total GMV, facilitated through our platform. This structure incentivizes us to help our merchants convert sales and increase AOV through the customer through the commerce and technology solutions offered by our platform. From consumers, we earn interest income on the simple interest loans that we purchase from our originating bank partners. Interest rates charged to our customers or consumers vary depending on the transaction risk, credit worthiness of the consumer, the repayment term selected by the consumer, the amount of the loan, etc. Now they say, if we move on here, they say how traditional credit debit cards can hurt consumers. They say in 2019, consumers paid approximately $121 billion in credit card interest, $11 billion in overdraft fees, $3 billion in late fees. That's according to a study from LendingTree. They said the revolving nature of credit cards and the incentives to pay off only minimum balances can succeed in keeping consumers in debt for long periods of time. They say in June 2020, as of that date, Americans owed nearly $1 trillion in credit card debt, evidencing the massive amount in consumer debt and the clear need for flexible payment options. They believe that cards also do not meet the buying needs of many consumers. They're an inflexible method of payment, particularly for consumers contemplating a higher value purchase. Debit cards restrict buying power to a consumer's account balance, constrain the ability to budget over time, and do not provide the optionality or ability to reasonably access credit. Now, this is really interesting what they're doing, because they're not really inventing a brand new thing. Essentially, they're just improving upon what's already been implemented. They're taking the credit and debit card and just making it slightly better. That's really what I like. They're taking a proven, profitable type of company, and they're just improving on it and changing it slightly. Now, whether they can also prove that this improved version is going to be a profitable company is another question. And they have been trending to profitability, and we'll take a look at their financial statements in a second here. But it's a really good question about, this is a good point that they're making, is what I'm trying to say. That's true. Debit cards really limit what you can do in terms of your account balance. Let's say you want to just pay something off over time, spread out that cost. Well, debit cards do not allow you to do that. Credit cards, though, as you can tell, nearly $1 trillion in total credit card debt here in the U.S. Americans owe a lot of money, and by limiting the late fees, by taking a lot of that away, and instead dealing directly with the merchants and making money that way, It's very, very interesting. So if we go to the top of this statement here, they say a lack of transparency by traditional financial and payment institutions, ranging from hidden penalties, hard to understand fine print, unwanted bundling of products, erosion of trust, and poor consumer experience. These views are particularly acute for the over 160 million Gen Z and millennials here in the U.S., many of whom prefer to build trusted relationships with brands and whom they engage and from when they buy products and services. For example, according to TD Ameritrade's bank's annual customer spending index, approximately 25% of millennials do not carry credit cards. Consumers are now turning to technology companies they trust. According to a survey conducted by the Harris Poll in 2020, 64% of Americans would consider purchasing or applying for financial products through a technology company's platform instead of traditional financial service provider. This sentiment rises to 81% for Americans aged between 18 and 34. I know I've spent a lot of time on this topic, but I just think it's super interesting and really important to show. Now let's go ahead and get into the consolidated statement of operations. This is my favorite part of S1 forms, looking at the numbers, looking at the data that we're dealing with this company. Can it be profitable? How's their revenue? Are they growing? Because all of the stuff that I've just mentioned, if they aren't going to be a profitable company, if they can't keep on growing their revenue, shrinking their losses, then all of that does not matter, because this might not be a worthwhile investment and this company might be headed to the ground. But that's not the case for Affirm at all. Total revenues have grown substantially. It really boosted by this current situation we're in with lockdowns, etc. Revenues for the fiscal year ended June 30th in 2019 were $264 million in 2019. That grew to over $500 million, $509 million, and to just be exact there. So that's an incredible growth, nearly double, nearly 100% growth during that time period from 2019. And then from 2020, year ending June 30th. That's incredible. If we do 3 months ended, you can tell 87 million in 2019 during the same time period, September 30th, and 173 million during 2020. Now, operating losses have also shrunk from 127 million in 2019 to 107 million in 2020. 3 months ended 32 million in 2019 to actually increase their loss to 44 million in 2020. Kind of an interesting thing there. Why did it increase during this time period? But on a yearly basis, it's decreased by about $20 million. So it's a good and kind of just a weird little tweak there. Maybe it's just this one period. Maybe they decided to acquire a company or spend a lot of money during there. Who knows? We'll have to look deeper into this company to figure that out. That's one thing I love about these analyses is it's really an investigation, because you may look at this and say, okay, their operating loss decreased, but why did it increase during one quarter? That doesn't really make much sense. It increased rapidly during one quarter, but it's decreasing overall. Really interesting. One thing I want to say is their revenue's increasing. Their operating loss on a yearly basis is decreasing. If we go to their net loss, it's also decreasing from 120 million in 2019 to 112 million in 2020. It's also increasing on a quarterly basis, unlike operating loss. So from 30 million all the way down to $15 million, nearly cut their net loss in half during that time period from ending September 30th, 2019 to 2020. I believe that's 3 months ended as well. It's great news. On top of that, they've also increased operating expenses. So loss on loan purchase equipment increased from 73 million to 161 million. Provisional for credit loss increased from 78 million to 105 million. Funding costs 25 to 32. Processing and servicing 32 to 29. On almost every single segment, technology and data analytics, $76 million in operating expenses to 122 million. Sales and marketing costs increased from 16 million to 25 million. And general and administrative costs increased from 88 million to 121 million, with total operating costs increasing from 391 million to 617 million. So they basically increased their total operating costs by, a little less than 50% there, probably more like 40%-ish. And the fact that they were able to increase their operating expenses, but decrease their net loss significantly as well as their operating loss, is great for this company. They can increase their operating expenses, keep boosting those expenses while their revenue grows, but they continue to decrease their loss over time, which means their margins are improving. It means their revenue's increasing rapidly, as we just saw. Clearly it's up 100% year over year. That's pretty incredible. So now let's go ahead and look at their consolidated balance sheet data. We have cash and cash equivalents. They had a $320 million in cash and cash equivalents as of June 30th, 2019. That decreased to $267 million. But as of September 30th, 2020, that increased all the way to $684 million in cash. So they have basically double the amount of cash they had as of June 30th, 2019. Or even in June 30th, 2020, more than double as of now, September 30th, 2020. It could be a little more now. So that's incredible. They either have got a lot of investment or they are just, holding on to a lot of cash for future purposes, whether they're going to acquire a company, keep growing, expanding, increase their operating costs more with that cash. They definitely could. And that's a really great sign for this company that their cash reserves are increasing. Total assets also increased to $2.2 billion as of September 30th, 2020, up from $1.4 billion as of June 30th, 2020. So during that short time period, they increased their total assets by just under $1 billion. That's pretty incredible. About 800 million to be exact. Funding debt decreased as well, which is great to see that their debt increased there. Total stockholders deficit did increase though, so increased from 263 million in 2019 as of June 30th to 367 as of June 30th, 2020. However, it decreased again down to 348 million as of September 30th, 2020, but they're still operating at a stockholders deficit, which is not something I like to see. But as long as that's decreasing and trending, as we said, they were trending towards profitability, decreasing their loss, even with increasing expenses. And now that, as of, September 30th, from June 30th, they decreased their stockholders deficit as well by about 20 million. That's a great sign as well. Now we can go ahead and look at gross merchandise volume, GMV, increased substantially. Active customers also increased substantially for fiscal year into June 30th. So 2019 GMV increased from 2.6 billion to 4.6 billion. Active customers increased from 2 million to over 3.6 million. Contribution profit increased from 64 million to 180 million. Transactions per active customer increases from 2 to 2.1. And contribution profit as a percentage of GMV increased from 2.5% to 3.9%. All great data right there. Now let's go ahead and look at this on a quarterly basis all the way back since September 30th, 2018. We'll go ahead and start with revenue here. They did $51 million in revenue September 30th, 2018. Let's go ahead and look at September 30th, 2020. Nearly $174 million in net revenue there. That's incredible growth. Let's go all the way down to the bottom here of the statement. Let's go ahead and look at the net income, which nearly almost every quarter is a loss. They had 25 million as of September 30th, 2018, a loss of 25 million, nearly 26 million. That's decreased to a loss of just 15 million now, September 30th, 2020. And they actually had a profit during June 30th, 2020, it looks like, of just about 35 million there, which is incredible. Operating loss also continues to increase with a profit during June 30th, 2020 of 39 million. It actually has increased from 2018, but you know what? They've done a lot of growth, a lot of expanding there. It's not something I'm extremely worried about. As of March 31st, 2020, it was 81 million, which they decreased to 44 million as of September 30th, 2020. They have a slight increase in operating loss, but in their operating income loss, but nothing too much to worry about, especially since net income is trending towards profitability over time. Now, I want to talk about the growth and their market opportunity here. According to eMarketer, global online sales grew 20% to approximately 3.4 trillion in 2019, expected to grow to approximately 5.8 trillion in 2023. So that's a huge growth. E-commerce still only accounts for 14% of total retail sales. I expect that to increase honestly, even more than 20% by then. Retail sales are just taking off, especially with this pandemic just fueling that fire. Every element of commerce is moving online, from storefronts to order fulfillment to payment to checkout experiences. Gen Z and millennials are early and frequent adopters of e-commerce and tend to prefer the ease, flexibility, and greater selection offered by shopping online. 100% agree with that. They said, for example, 70% of millennials prefer shopping online. In the United States, according to the U.S. Department of e-commerce sales as a percentage of total sales jumped from 11.8% to over 16.1% between the first and second calendar quarters of 2020, pretty much all fueled by the pandemic and lockdown orders. So anyways, the market opportunity for this company is huge. They're in a growing market. It's great to see. They're trending towards profitability. They have a stockholders deficit, but it is decreasing slightly. As long as they continue on this trend and there isn't a random reversal, it's going to be a great company. They want to expand their customer reach for their growth strategy, drive repeat use, and innovate on new product solutions, expand their market reach as well. They want to increase their number of merchant partnerships. I want them to keep operating with new companies, keep making new partnerships. They've been doing great every year. As we looked at before at the beginning of this video, we see that they had, Shopify, Peloton, and they're going to continue to get more and more merchant partnerships, which will drive revenue as well. I think they could also start to cut costs eventually once they begin to cut their marketing costs. Although for now, I've never used their app. I honestly didn't really hear about them that much before this IPO. So they definitely should increase their sales and marketing costs over time. I'm completely comfortable with that increasing as an investor, especially if it's increasing and they're still able to lower their net loss over time. That's awesome. They also want to increase merchant feature functionality. So now let's go over a summary of Affirm. And this has been kind of a long video here. They're heading towards profitability. They have a great leader with, he has a history with PayPal, very successful history there. Current situation is boosting Affirm's growth. So we're confident, or semi-confident at least, in the good leadership of this company. They're heading towards profitability, at least that's what the trend states. And the current situation is boosting Affirm's growth pretty rapidly. We've seen that in the increase of customer usage, as well as the usage of e-commerce as an entire market. They need to reach sustained profitability. They have a stockholders deficit, definitely some negatives there. But again, those are all They're trending towards profitability, and that stockholders deficit is slightly decreasing, at least on a quarterly basis. They need to reverse their deficit trend. As I said, they still need to do that. I don't know. Personally, investing in a company with a large stockholders deficit is just a big red flag to me. But they are a tech company, and these days it's really not a surprise. Nearly every company is trading with a stockholders deficit if they're IPOing and are in the tech sector. But hopefully that trend continues to go to a positive not stockholders deficit. Sorry, I'm fumbling on my words. I'm unsure the IPO will go. This isn't like Airbnb or DoorDash. It's not as a well-known company, but I believe it will be a very successful IPO. They did postpone their IPO. I think that was a great move. Thanks for watching. Please subscribe, twitter.com/StockerFinance for more information, for some comments on the entire financial markets, investing news, etc. Check out these videos as well. I've got new videos coming out every day this week, Monday through Friday. Patreon.com/StockerFinance.